When Shanghai closes for a 7-day holiday, what happens to silver price discovery in the world's largest physical precious metals market? More importantly, what does it mean when that closure coincides with silver testing critical support levels that have held since early 2024? And how should investors thinking in multi-year time horizons interpret a temporary liquidity vacuum in the context of broader monetary policy shifts and industrial demand fundamentals? If you're holding physical silver or considering allocation adjustments right now, subscribe to the channel and hit the bell icon so you don't miss the next update. And if this analysis helps clarify the structural forces at play, go ahead and hit the like button. Let's start with what's actually happening in the market right now. Silver closed Friday at $76.30 per ounce, down 2.4% from the prior session. That pullback followed a 3-week rally that pushed silver from $68 in late January to a brief test of $81 on February 14th. The current price sits almost exactly at the level that has acted as support 4 separate times since April of last year. That $76 floor has psychological weight, but more importantly, it represents a zone where physical buyers have consistently absorbed selling pressure over the past 10 months. Shanghai Gold Exchange, which handles the majority of China's gold and silver trading volume, closes Monday for the Lunar New Year holiday and remains shut through the following Sunday. That's 7 consecutive trading days where the world's second largest economy and arguably the most active physical silver market will be offline. During that window, price discovery shifts almost entirely to Western markets, specifically COMEX futures and London spot trading. The immediate question is whether that $76 support level can hold without the backstop of Shanghai physical demand. Historically, periods when Shanghai is closed have shown higher intraday volatility in silver prices, not because Chinese traders are more stabilizing, but because the absence of any major participant reduces overall liquidity. Lower liquidity amplifies price swings in both directions. A 500-lot sell order that might move silver 30 cents on a normal day could move it 70 cents when Shanghai is dark. That structural reality matters more than sentiment or technical patterns. Now let's zoom out and consider what's been driving silver over the past 6 months. The metal rallied 43% from its October low of $53 to the February peak of $81. That move wasn't driven by a single catalyst, but by a convergence of 3 forces. First, real yields on 10-year Treasury inflation-protected securities remained negative for most of that period, meaning investors holding government bonds were losing purchasing power after adjusting for inflation. When real yields are negative, the opportunity cost of holding non-yielding assets like silver declines. At the same time, headline inflation data remained elevated, with CPI running between 3.2 and 3.7% year over year for the past 4 months. That's well above the Federal Reserve's 2% target and keeps pressure on the purchasing power of fiat currency. Second, industrial demand for silver has been structuring upward because of solar panel manufacturing expansion and electric vehicle component growth. Silver consumption in photovoltaic cells alone rose by approximately 18% year over year in 2024, according to industry data. Electric vehicle production uses roughly twice as much silver per unit compared to internal combustion vehicles, and EV market share continues climbing. These aren't speculative trends, but established demand shifts that don't reverse quickly. Third, central bank gold purchases remained near record highs throughout 2024, with emerging market central banks adding over 1,000 metric tons to reserves. While central banks don't typically buy silver, their rotation into physical gold signals a broader reassessment of reserve asset allocation away from dollar-denominated debt. That shift in institutional preference creates a halo effect across precious metals generally. So the rally from $53 to $81 had fundamental support. The question is whether the current pullback to $76 represents a healthy consolidation within an intact uptrend, or the beginning of a deeper correction. That depends on how you're thinking about capital allocation and time horizon. If you're trading silver on a 2-week or 2-month basis, the Shanghai closure creates tactical uncertainty. Without that physical bid supporting the market, a cluster of stop-loss orders below $76 could trigger a cascade move down to $72 or even $68 before buyers reemerge. Short-term traders need to manage that risk with position sizing and clear exit levels. But if you're allocating capital with a 3-year to 5-year outlook, the 7-day Shanghai blackout is statistical noise. What matters is whether the structural factors that drove silver from $53 to $81 remain intact. And on that question, the data is reasonably clear. Real yields are still negative. The Federal Reserve has signaled potential rate cuts later this year if inflation continues trending toward target, which would likely push real yields even more negative. Industrial silver demand isn't slowing. Solar installation capacity is projected to grow another 22% in 2025, based on current government incentives and corporate commitments. Central bank behavior hasn't changed. Reserve managers in China, India, Turkey, and Poland continue adding gold at a pace that suggests long-term strategic repositioning rather than short-term trading. None of those drivers disappear because Shanghai is closed for a week. Now let's talk about what could actually break the $76 floor in a meaningful way. A sustained move below $76 that holds for more than a few sessions would require one of three scenarios. First, a sharp reversal in inflation data. If the next CPI print comes in at 2.1% year over year and core inflation drops below 2.5%, that would shift Federal Reserve policy expectations. Markets would begin pricing in fewer rate cuts and potentially even a rate hike if employment data remains strong. Real yields would rise, increasing the opportunity cost of holding silver. In that scenario, silver could retest the $68 to $70 range as capital rotates back into yield-bearing instruments. Second, a major de-escalation in geopolitical risk. Silver and gold both carry a risk premium tied to uncertainty around trade policy, fiscal deficits, and global conflict. If those risks diminish rapidly, the premium compresses. That doesn't mean silver crashes, but it could easily correct 10 to 15% as positioning unwinds. Third, a technical breakdown in industrial demand. This is the least likely near-term scenario but would have the most durable impact. If electric vehicle sales stall or solar installation subsidies get cut sharply across multiple regions, the structural demand thesis weakens. Silver would revert to being primarily a monetary metal rather than an industrial commodity with monetary characteristics. That would increase volatility and make the metal more sensitive to financial market sentiment. Each of those scenarios is possible, but none are currently the base case. Inflation remains sticky, geopolitical uncertainty persists, and industrial demand trends are still positive. So while the $76 level is under pressure during the Shanghai closure, the balance of probabilities favors consolidation rather than collapse. Let's consider the bullish scenario as well. If silver holds $76 through the next week and Shanghai reopens with strong physical demand, the path back toward $81 and potentially higher becomes more likely. Here's why. When a support level gets tested multiple times and holds, it gains credibility. Traders who sold expecting a breakdown get caught off sides and have to cover. Physical buyers who were waiting for lower prices realize the dip isn't coming and start accumulating. That combination can create sharp reversals. If silver moves back above $80 decisively, the next technical target sits around $86 to $88 based on the 2023 highs. But more important than technical levels is the macro backdrop. If the Federal Reserve cuts rates twice in 2025, as some analysts expect, real yields could go deeply negative. A scenario where 10-year Treasury yields are at 4%, but inflation is running at 3.5%, creates a negative real yield of minus 50 basis points. In that environment, the opportunity cost of holding silver is essentially zero and the inflation hedge premium increases. Over a 5-year window, silver at $76 could compound at 6 to 8% annually just from monetary debasement and industrial demand growth. That's not a guaranteed return, but it's a reasonable probability-weighted expectation. Compare that to holding cash at 4% nominal when inflation is running 3.5%, and the real return is only 50 basis points. Silver offers optionality and asymmetry that cash doesn't. Now, let's address a question that often comes up in these discussions. Why does a one-week market closure matter at all if the long-term thesis is intact? The answer is liquidity risk and short-term capital preservation. Even if you're holding silver for 5 years, a sharp 20% drawdown in the next 2 weeks creates psychological pressure and forces position reassessment. If you allocated 10% of your portfolio to silver at $80 and it drops to $64, your overall portfolio takes a 1.6% hit. That's manageable if you have dry powder and conviction, but it's uncomfortable if you're fully allocated. Understanding that the Shanghai closure increases near-term volatility helps you manage position sizing appropriately. If you're holding physical silver in allocated storage, the 7-day blackout means almost nothing. You're not trading in and out, and short-term price swings don't affect your long-term positioning. But if you're holding silver through futures contracts or leveraged ETFs, the liquidity vacuum can trigger margin calls or stop-outs, even if the underlying thesis is correct. That's why professional investors scale into positions rather than going all in at a single price point. Buying 30% of your intended allocation at $80, 30% at $76, and holding 40% in reserve for a potential dip to $70 gives you optionality without abandoning the trade. It also reduces the emotional impact of near-term volatility. Let's put some numbers around a longer time horizon scenario. Assume silver is currently $76 and you're considering allocation over the next decade. In a baseline scenario where inflation averages 3% annually and industrial demand grows modestly, silver could reach $110 to $120 by 2035. That's roughly a 4% annual return in nominal terms, or about 1% real return after inflation. Not spectacular, but better than holding cash that's guaranteed to lose purchasing power. In a more bullish scenario where fiscal deficits force continued monetary expansion and industrial demand accelerates, silver could reach $160 to $180 by 2035. That would be roughly 7.5% annualized nominal returns, or 4.5% real. Comparable to equity market returns, but with different risk characteristics. In a bearish scenario where inflation gets crushed back to 1% and industrial demand stagnates, silver could trade sideways or even decline to $60 over the next decade. That's a 1.5% annual loss in nominal terms and worse in real terms. The key is understanding which scenario has the highest probability and positioning accordingly. Given current debt levels, political constraints on fiscal discipline, and established industrial demand trends, the baseline to bullish scenarios appear more probable than the bearish case. That doesn't eliminate downside risk, but it shifts the probability distribution in favor of maintaining or increasing precious metals exposure. What about the opportunity cost argument? If equities return 8% annually and silver returns 4%, aren't you better off in stocks? The answer depends on correlation and portfolio construction. Silver and gold tend to perform well when traditional assets are under stress. During periods of currency debasement, rising inflation, or financial system instability, precious metals often appreciate while stocks and bonds decline. That negative correlation is valuable for portfolio stability. A portfolio that's 80% equities and 20% precious metals will likely have lower volatility and better risk-adjusted returns than a portfolio that's 100% equities, even if the all-equity portfolio has higher absolute returns in benign environments. The precious metals allocation acts as insurance that occasionally pays out rather than pure return-seeking capital. So the framework isn't silver versus stocks, but silver as a complement to stocks within a diversified portfolio. The Shanghai closure is a reminder that precious metals markets are global and that liquidity can shift rapidly. But it's not a reason to abandon a thesis built on structural factors that persist regardless of short-term trading windows. If $76 breaks decisively and silver moves towards $70 or $68 over the next 2 weeks, that could represent a better entry point rather than a reason to exit. Conversely, if $76 holds and silver rebounds toward $82 when Shanghai reopens, the consolidation will have confirmed support and increased the probability of a move toward new highs. Either way, the 7-day blackout is a test of market structure rather than a fundamental shift in the underlying thesis. For investors focused on capital preservation and long-term purchasing power, the question isn't whether silver dips 3% or rallies 5% next week. The question is whether holding a meaningful allocation to physical precious metals remains a rational hedge against monetary instability, inflation risk, and portfolio concentration in financial assets. On that question, the case remains intact. So what's the takeaway from all of this? Silver is testing critical support at $76 during a period of reduced liquidity because Shanghai is closed for 7 days. That creates near-term volatility risk, but doesn't change the structural drivers that pushed the metal from $53 to $81 over the past 4 months. Real yields remain negative, industrial demand is growing, and central banks continue rotating into physical reserves. Those factors support a baseline scenario where silver consolidates in the $70 to $85 range before potentially pushing higher later in the year. The bearish case would require a major shift in inflation data or industrial demand, neither of which appears imminent. The bullish case accelerates if real yields stay negative and geopolitical uncertainty persists. For long-term investors, the Shanghai closure is a tactical event within a strategic framework. Position sizing and liquidity management matter, but the core thesis around precious metals as portfolio diversifiers and inflation hedges remains relevant. I'd like to hear your perspective on this. Are you viewing the current pullback as a buying opportunity or a signal to reduce exposure? Drop a comment below with your thoughts or any questions about the analysis. And if you found this breakdown useful, make sure you're subscribed to the channel with notifications turned on so you catch the next update. Go ahead and hit the like button if this added clarity to your thinking on silver's price action and the Shanghai closure. Thanks for watching, and I'll see you in the next one.